Hi, everybody. Today is Wednesday, the usual Misfit happy hour. It's September 7th. The S&P, in case you're watching this at a later date, the S&P closed at approximately 39.80, 100 off the lows, and the first up day after 9 something straight down days. Predicated on people believing that the Fed was going to be serious about their attack on inflation. And so today, big 100 handle move off the lows, and we're joined by my dear friend for over 30 years, Steve Hawkins, who I met in 1991 when he came to the NYMEX, and the big thing was we had a week-long class on this new software, which was paid for, I believe, by the NYMEX. Is that right, Stephen?
Yeah. They actually invested in the software product, and they were partners in the software. Yes.
And so, right, we had to go to class. It was from 9 to 3 it was from 3 to 7 or something.
6 or 7, yeah.
Yeah, at night for a week. And so the room was filled with probably 200, 300 people.
Right. And that's when Danny Rappaport was head of the NYMEX way back then, right?
Very much so, yes. And Danny, if you're watching, I hope you're still windsurfing. And we learned about this whole idea of the markets going from this horizontal distribution to a now more vertical distribution. And we needed a way to sort of, and as Pete would say back then, and Steve was there too, to segment data. And for all of us who were in the ring, we were like, segment data. And Pete was convinced that was the future. We needed to segment data. And that was interesting because they were trying to let the market self-organize itself outside of using time as a metric, right? Pete used to say, I think Stephen, he used to say that price only existed to facilitate the transaction, and time wasn't a relative metric in the 24-hour marketplace, which he knew was coming. It hadn't come yet, right? Right. So, I mean, whose idea was that? Was that Pete's idea?
Oh yeah. I mean, as you know, I mean, sitting through his class, he was kind of a bit of a visionary. You know, he sat on the board of directors for the exchange, and the whole idea of the market profile, came from Les Rosenthal. He was the president of the exchange, and Les was looking for ways to increase volume or activity on the trading floor. And so he approached Pete. You know, Pete was a young trader at the time, and very, very well respected and knowledgeable, graduate of Berkeley. And then so they put the responsibility on him to try to find a way to create a visual or some type of a way to organize data that it would be available to outside participants and hopefully generate order flow for the exchange. And came up with a profile, I think, in the early 80s, and the Board of Trade had the rights to they derived the revenues from the rights of the market profile display, and now that's owned by the Mercantile Exchange. So, that's the whole progression of that. And in the late 80s, early 90s, we realized that kind of the markets have changed. And way back then, the market opened and closed. We had a kind of a market imposed time frame. So the majority of the activity was, people traded for the day, so they got in and they got out by the end of the day. So once that started to change with the advent of funds and things like that, the whole dynamic of how you should organize data and display data changed, and that's when we started the self-organization process that you're talking about.
Yeah. Hey, was Pete a big trader? I think he was, right? He was a big grain trader. Beans? Was he mostly trading beans?
Yeah. He was kind of unique on the floor. I think most traders on the exchange floor, they would stay to one bit, and then kind of, make markets and then trade and maybe trade a shorter term time horizon. He was unique. He would float around and he would trade a longer time frame perspective. And so he would put on his position, and do something in the beans or the corn or the wheat. And way back then, that the SIBO was starting, and maybe go make a market in an equity option, or go do something in the fixed income market. But he was for sure one of the more successful traders on the trading floor. And I think one of the stories about him is he was approached, by a group of doctors. They wanted him to manage, $10 million, when $10 million was a lot of money. And he turned him down because he just didn't like the responsibility, or he wanted the independence of not answering to anyone. So that's always been his approach to life, is he really wants to be responsible to himself and not really being in the corporate environment, and trading is a perfect place for that.
I remember he was very much tough love in class. It would be as though he would say for people who are just tuning in and are unfamiliar, Pete taught classes at DePaul University on the weekends, and I would fly from New York, and maybe they occurred twice or three times a year, and it was a whole weekend from
Yeah.
nine until 4, right, on a Saturday and a Sunday.
Yeah.
And it was a commitment for people, I think, especially traders who didn't want to burn their whole weekend sitting in a classroom. And
Right.
and Pete was not necessarily the most forgiving, to the point where you I mean, I had been, I'll put it this way, I was very careful about asking my questions, but I had seen people ask a question and Pete would say, we've already answered that in the prior classes and you weren't here. So go fuck yourself. Go,
Right.
sorry, you can go
Right.
away. And then, but Pete also had friends on the floor, right? I remember he told the story about a guy who came to the floor and was standing in the bond pit and had been charting, doing point and figure or something like that, or doing profiles. But everything back then, of course, there was no computer. It was all done on graph paper.
Yeah.
And he had stood there for a couple months or something. And Pete said that, Pete came into the ring and the guy had never traded. And Pete asked him how the market was, and he said 7 bid at 8, and Pete just said sold you 100.
Right.
That's a true story, right?
Oh yeah, no, I remember something along those lines. Yeah, no, trial by fire. I mean, he's certainly not an advocate of paper trading or simulated trading. He thinks you really have to get in there, roll up your sleeves, and deal with the financial as well as the psychological aspects of trading. And if you're just trying to do something in a simulated environment, it's just not realistic. So
Yeah,
that's been his perspective, and I think it's sound advice.
he used to say all the time, right? We had to put on the trade so that we could have the benefit of staying in the trade as long as possible before, if it was going to go bad. Like we wanted to have the right entry location, so you at least had a peek at looking at the thing before you had to make the decision if it was bad or not.
Yeah, yeah. I was at his saying, stay as long as you can without overstaying. That's kind
Right.
of one his mandate as far as trading goes.
And then remember there was the phase where he was trying to make a program that would automatically execute the trade for you, and then your job was just to decide whether or not you wanted it or not.
Right. Yeah.
Right? It was like, okay, here's your ice cream cone, yes or no.
Right. I mean, the whole idea behind that is based upon the data. It had some type of a bias, and so the computer would generate the trade. They would essentially put it in your, you'd get the trade. Then your responsibility was to manage the trade, and how could you manage the trade relative to the computer? And that would be the alpha that you could add to the strategy, right? So
yep.
If you could outperform the computer, then there'd be a value. And if you could not perform the computer, then I guess you're replaceable, right?
Yeah, I remember his argument was like you didn't have to worry about the execution. It was just as though you had to worry about, like, do I want it or not? And it made the operation of the whole thing.
I mean, that revolves partially around his philosophy, and I think what we've always talked about is the amount of time a person spends looking for a trade versus managing it. And most people might spend 3/4 of the time looking for a trade and 25% managing, and you think the ratio should be switched around. So, flip a coin and buy or sell like he did for the individual, and then the burden is on the individual to manage the trade, and that's where the really separates one's understanding of the market and their ability to generate a P&L versus something that most people, like I said, they're going to spend more of their time looking for something.
It seems like he didn't run with a pack, right? He was kind of just his own man on the floor, from what I mean, he had friends in the lunchroom and things like that, right?
Right.
But
no, I think, he was a popular guy, but he definitely was I don't know what word is renegade, but he certainly was different as a trading approach versus everyone else.
Yeah, he definitely had a different opinion, right? And then he even worked on wasn't in charge of new product development or something, right, for a while.
He did a lot of things. He was always active in trying to make the exchange better. He was a big board of trade guy, and he certainly was advocating for it.
Remember, he used to talk about like if there wasn't like the ladder wasn't going to have enough top of book, that there was going to be too much money to be going through the top of book on the ladder, and we would get to the point where things were just going to go so vertically. God, he was way ahead of his time.
Yeah, yeah, he was kind of visionary. I'm sure you remember back in 80, 88, 89, or probably 98, 99, he's talking about a top in the market. And then, obviously the market topped out Y2K, and then he's talking about a big upturn in the market. And so he's really got a good perspective of, what's going on in the global economy and how it's going to impact things for sure.
Yeah, I'm looking through my notes here from 2004, from a class in 2004. I still have the notes. And it says best to sell a failing buy program rather than sell a sell signal.
Yeah. Mm-hmm.
And
Yeah,
then
goes in line with what I talk about is if buyers are stuck, right? So you
yep.
got double positive as far as being short. The longs are stuck and shorts can lean against an excess now, right?
Right. Yes, certainly. Again, it's sort of like over the horizon, like
Mm-hmm.
she's, not going to call me back before she realizes that, that she's not calling back. You save yourself the second date. And then who was Jim Stafford? Is that the grain
Yeah,
trader guy who said, what did he say? It's that you have to be aware of what's not happening.
yeah, that's John Stafford. He was a
John
big,
Stafford.
he was a big SIBO guy. He had a big group over there, and he was probably the biggest market maker in the market in the SPY over there. But he always say what's more important than what does happen is what doesn't. So you get a bullish grain report and the market doesn't rally, or you get a bullish non-farm hard payroll number, the market doesn't rally. What does that mean? Probably everyone's already positioned long, right?
Yeah,
So what's left to happen? Longs need to get out now when it doesn't rally, and now shorts can try to sell.
and in those days, right, the ring had more money than the institutions, right?
Right.
The
Mm-hmm.
boys could definitely take on the houses, right?
Right. Yeah, and that was way back then, but that's all that changed in the early 90s, right? That's
Oh
part of
yeah.
the software, and probably even prior to that, better than that than myself. But for sure, just the see what tutors of the world and all the CTAs and everything else. Now you're just a little fish, in a big pond, right? Before you're the big fish in a small pond.
I was swept up in a Twitter feed. There were guys from the old Merck guys were sharing stories without real names, but they talked
Okay.
about a guy in the meets who was a big trader using his orders coming from off the floor, but was also a member. And he said that the story went like this, that he was upset that people were front running his orders that he was calling in. And then so he went to the floor and he bought the whole market limit bid.
Okay.
And then he turned and said, sold, and I want everything.
Okay.
And that it went down 3 days, it went limit 3 days.
Limit 3 days. Okay.
Yeah. Were meat guys? I mean, that was a club, right? You had to be in the club to trade the meats.
Yeah, I think, it's a CME. I mean, the Board of Trade, I would say that, the handful of contracts they had there, which is primarily the fixed income and the grains, those were pretty deep markets. But, over at the CME, you had like the meats, you had the orange juice, you have milk, you have, markets are relatively illiquid. And like you said, that's definitely an old boys club. All the guys commiserate amongst themselves and understand where all the orders are and who's doing what, and kind of run it. So
Yeah, for here in New York, it was like Aldo was huge in the coffee, right? And
okay,
right, and coffee was an Italian ring.
okay,
And you definitely needed Aldo's approval if you were going to step into that ring as a
okay.
local, things like that.
Uh-huh.
So anyway, any other good, do you remember any, like you said he had a trade that had gone his way for something like 100 days?
Yeah, I remember he told me about a meal trade he had, long or short. I don't remember. I assume probably long, but that's way back then when he first got involved in the markets. You might see the yearly range for a corn contract might be 10 or 15 or 20 cents.
That's
Back
right.
then, maybe traded eighths instead of quarters, but volatility was minimal. But yeah, he said that he had a trade where he had more positive equity in his trade every day over months, which we don't see today, right? I mean, it's,
No, we don't see that ever. I mean,
yeah,
I'm looking at a thing, my notes here, and he says at one point in 2004, he says he doesn't want to trade late. He says
right,
it's earlier trades are better. Can't be defined as wrong yet.
right. You know, that kind of goes against the constitution of most people, right? I mean, most people are looking for a lot of confirmations. They want to see a lot of all their ducks lined up, and then they pull the trigger, and that's probably the wrong time to do so.
Yeah, everybody wants to talk about their trade over the dinner table, right?
Yeah, that's right. So
All
our whole philosophy on trading is trade early and trade often. The later you trade I mean, like market's an auction, right? So you're going to have a vertical move, then some consolidation, and then maybe a attempted reversal or continuation. So at least if you're trading early, you're going with the flow. The later you are in the cycle, it's two-sided, right? It could continue or it could reverse.
right. As more people get on board, the obviously the odds of a retracement increase.
Yeah.
Right. And so if we're right early, then right, Pete used to always say if you're coming from a balanced position, the odds of a retracement are 0.
Yeah. Right. Yeah, I remember reading about the minimum trend, right? It's in the books we wrote about, and just what is the minimum trend? Just a little imbalance in the market, and just kind of the whole analogy of a butterfly flapping his wings and creating a tsunami the other side of the ocean. I mean, the same thing with a little imbalance in the marketplace.
He said, yeah, once you get an imbalance in the marketplace, it's really hard to get it out of
Yeah,
the market, right? Like it's once there's, and then he used to say, which I always still have problems with, maybe you can help me with this, that you needed light opposite activity for a trend to continue.
yeah. I mean, you need people on the wrong side of the market to continue with that direction, right?
Right.
I mean, yeah, because otherwise, once everyone's bought, he's saying all the king's horses, all the king's men, then what can happen? It can only go one way, the other way, right?
Yep. And that's, like Hammer of HFT was always, Steve Hammer was talking about how you can fade a vertical move,
Uh-huh.
right? If it's so vertical, and then you've obviously stripped out everything in the path, and then there's nothing behind it. In
Right.
other words, you've cleaned out the deck, right?
Yeah. That's kind of my whole way of looking at markets, is trying to look for that heavy volume, right, to be exhaustive. And if nothing else, that should be a point at where the market should trade sideways or potential reverse. So that's the same thing with a trend day, right?
Yep.
You're building higher highs and higher lows, or lower highs and lower lows. The probability of it continuing in that direction the next day are quite small. So that's a good position area to try to sell volatility or look for some type of a price reverse.
Yeah. Yeah. And here's another thing he's always says, learn from your mistakes, obviously.
Right.
Find good opportunities, it equals good results. He's always, this is a super old one, right? Wow, check this out. Check this out. Remember that?
Yeah.
That's probably from the 90s. We're talking about this. He says, listen to the market, let the market talk to you. The activity levels crucial to direction. Watch the foreground and the background. That's what you still do, don't you?
Oh, yeah. I mean, I think most people do that, right? They're looking at a 5-minute versus an hourly, or daily versus a 30-minute. I mean, I think that's pretty common amongst the trading community to have some perspective of what's going on now versus what's going on, whether it's a day ago or a week ago. It kind of helps put everything in context. That's important.
Yeah, the foreground versus the background. You always say that. Learn from your mistakes. He says trade on the wings or the extremes. He
Yeah.
says when you're active, you develop a feel.
Right. That comes from his floor trading experiences, right? You kind of,
Yeah.
if you're in the pit, mixing it up and trading actively, you can kind of get a feel for, how the bids and offers are being accepted or rejected, and then kind of try to trade the flows.
Internal conflict leads to change, change must continue. And then the quickest, fastest move usually always sets the new direction, which is
Right.
still valid, right?
Oh, yeah. I mean, that's kind of the whole idea of something something developing quickly, like a skinny profile or whatever. I mean, that's kind
Right.
of setting up the direction. And like we've always said, that's going to have a staying power duration of at least 2 to 3 units. So it's the next 12 to 18 hours, you should have a direction in place.
And here's the make sure that one direction is closed off.
Yeah, that's kind of always, at least our philosophy has always been, back yourself up against the wall and just trade one side of the market. you don't want to be trading, bids and offers to make your P&L. You want to be just playing the long side and selling to get out and then buying the setback. It's really difficult to trade, both sides of the market, just, psychologically.
Yeah, or reversing for that matter.
Yeah,
And
right.
and what's funny, he's kind of most famous for his quote about always do the hard trade.
Right.
Right? That's essentially what's the most difficult thing, and obviously the hard thing to do. And then here he says, make sure that something is really happening when you trade. Like, you don't want to be lured into a false.
Yeah.
He never really traded on hunches, did he? He always would say that when he got into a trade, he would how should we say, he would assess how the market is doing or how the position was working in regards to the market, and he would kind of say, like, maybe there's more to this trade, or it's time to go. And when he exited trades, he always told us that we had to get out of the whole thing, right? Like when
he wasn't into scaling in and scaling out. His thought or philosophy was always, you want to be all in or all out. I mean, not sitting on the fence or just kind of positioning to cover some expenses or lock in a profit. I mean, the market's selling, you should be long or you should be short, or, I mean, there's times where you shouldn't be involved, but, essentially, if you got a position going, you want to be looking at it objectively, and is it working in your favor? Is there things lined up that are favorable for you to continue, or is something kind of conflict with that, and it's time to get out? And that's always one thing that is nice about trading, right? You can get back in. It's not expensive nowadays, right? Commissions and things like that, and that kind of, a lot of people better than I do, as far as gives you a lot of clarity as a thought if you're out of a position and you kind of reassess things, versus you got your you've got your position going and managing it with address and anxiety of holding a position.
And in those days, right, we used to have to be friends with the clearing members, right? Because we didn't have instantaneous risk management, right? It was like, you'd get maybe a call from risk if you were like way overextended, but they usually give you 2 or 3 days to make the call, or you could just get smaller.
Right. No, I mean, that's back then. It wasn't so much a business, right? Your relationship with the clearinghouse, and obviously, you felt a responsibility to the clearinghouse, right, as far as not putting them out of business. So you certainly would not want to put them in a bad position. So you did everything in your control to try to make sure that everything was working out as far as your ability to margin the trade, and if it didn't, then there were discussions, and we've all heard of the stories of people that blow up and what happens afterwards, as far as how they got a full-time job at least and paying their debit off, right?
Yeah, I mean, for people who are watching in the old days, when people in Chicago in the pits would trade, they would just basically give the house that they were giving up on that. It would be Shearson sold them, and Cargill bought them. Is that right? Is that how it would work?
Yeah. Yeah. Then the trades would be entered in the back office as far as who the trade was going to and who was on the other side. And I think back then, wasn't it, from a regulatory standpoint, I think they had to be, key punch had to be within a half hour or something like that.
Yeah, something like that. I remember everything was done by hand, and it was certainly written. Yeah. It was all in your wrist. And then, those cards then were sent to the back office where the clerks would write them up. I was a clerk in the day.
Oh, yeah.
And then the clearing firm's job was then to send the right amount of contracts to each individual account.
Right.
Like that.
And out trades the next morning and all that kind of stuff, right?
Right, where you hope that you would come in praying that you did not have out trades, right? Praying forever. And then
stuff, right?
Yeah, I mean, did people think Pete was like a visionary, or did they think he was just like this guy with a wacky idea?
No, as you mentioned, we would do classes at Paul, and we would do classes in our offices of the Board of Trade. But even prior to that, early on, down in the cafeteria, that was his first opportunity to educate the masses on the market profile. So over lunch, you might get 10, 20, 30 guys sitting around and down in the cafeteria, and he'd go on for, half hour, an hour about what it's all about, what the approach is all about, and how to utilize it. And so, I think that he, besides making lots of money, and, he was always a unique, a unique type of guy. I mean, you hear all kinds of stories about someone would ask his opinion of something and he would give it to him, and then they start giving him theirs, and he would just, I don't want to hear your opinion, thank you.
Go away. Remember when he talked about his dad telling him, like, why are you going to asking him why you're going to the floor?
Yeah,
Those stories, right?
right.
Let me see if I get this right. His dad would be like, you don't stand much of a chance there.
Yeah,
And Pete was like, that's the reason I'm going.
right.
Is that right?
Oh, yeah. I mean, he was a unique type of a guy. He went to Berkeley. He was super intelligent. He was a good athlete. He was a creative thinker. Is everything he did. He saw the opportunity. I think the story was he got in college, maybe he had a brokerage account, and he made a lot of money back then in his brokerage account. Maybe while still going to university, and he bought a membership. I mean, then he moved out to Chicago and did the floor trading thing, and he blew up the first time, like lots of people do. And then, so he had his tail between his legs and had to go back out west, I think, to California, and kind of build up a nest egg again. And the next time around, he made it, obviously. But I think that he's quite unique, and like you said, the data organization part of things. I think he would visualize a profile in his head and just like you said, a point and figure chart. I guess that's the next best thing, right?
Mm-hmm.
But his ability to visualize it and just kind of look at it over multiple markets, and then just his ability to kind of read the market and have good discipline really kind of created lots of wealth for him. He's lots of money on the floor and bought lots of real estate in California, and is in a real good position.
To everybody watching, we occasionally use was, but Pete is still alive and
Right.
would probably love to get on a soapbox, and maybe if we beg and
Maybe
plead.
sometime in the future, right? We're working on new ideas now, and maybe
Yeah, for people. Right, for people writing programs, how many builds have you built on Pete's program? It's like, I think it's 2,158 is what I'm running.
Right.
I mean, and so in Pete's classes, which he's going to explain to people how this software, which exists outside of time, right? You're trying to measure data in a self-organizing fashion. And he says here in this piece, he says, do not buy somebody else's problem.
Right. Yeah. No.
Very right. Do not, if you see the market moving vertical, do not get in the way of that, people, right? You don't. Why would you want to be the first one to buy someone else's problem?
Right. Well, that's kind of always some of the different things we developed, like as far as trying to understand where the market is relative to the whole process of building a block of trades or accumulating price, and where's the best place to be, the last one to buy at a price versus the first one, right?
Mm-hmm.
So unless you're going to have a quick failure reversal of price, it's more prudent to try to wait for the market to trade a certain amount of volume before it can reverse. And so those are some of the things he's tried to understand, is what amount of volume is going to be trading at a price before it's going to move away from it. So you get close to that sweet spot, then you're in a good position if you're on the right side of it, of course, obviously.
Yeah. What's your thinking on volume? What's the most recent, or at least it used to be that we would think the top or the bottom of a move would be two gigantic forces coming together like this, right? Is it? But it seems to be, and I think you and I have talked about this a little bit, and I give you 100% credit, is that the tops and bottoms are a lack of volume from one side.
Right. Mm-hmm. Mm-hmm.
To the point where high prices shut off buying.
Yeah.
And low prices shut off selling, rather than this gigantic
tug of war, so to speak. Right.
Yeah, I mean, and so I don't know if anybody out there has the exact answer on this, but from Steve's and my conversations, that seems to be what I gather is so it's kind of as though tops are more of an anticlimactic event, as though look for what's not happening. Is it John or Jim Staff?
John Stafford, yeah,
John
Stafford.
Stafford said
Right,
that, right? Look for what's not happening
right,
at lows or highs,
right. Hmm.
which is more difficult to trade, because how little
Right,
is little versus, I mean, it's easy to see like a giant battle happening.
right. A giant spike, and just looking at the book for the, the delta, market delta, or something like that. That's kind of giving you are they buying bids or buying offers, or what's going on in the marketplace?
Yeah. Um, I mean, it's amazing to look at notes for that are 20 years old and still see things that we can talk about today
Right.
as as
I mean, that's kind of a good thing based upon a person who's starting or learning how to trade. You can understand that what you're learning, hopefully today, is going to be relevant 20 years from now, right? As opposed to a lot of people develop systems, right? You always got to, tweak it, and then I mean, like I was talking to a guy today, he's interested in the software. He's a private equity guy, and then he was starting to learn how to trade on the side. And what we were we were kind of talking about is, what's going on in the marketplace, and what's a good approach to trading, and I think the good thing about understanding a methodology is it's kind of like a pyramid. You build from the base up, right? So if you're being from the trading floor, none of these people listening now are ever going to be on a trading floor because
no.
never been on the trading floor. But if they understand what an auction is, then what is an auction? Back in the day, that's when the bell would ring. Today, I guess an auction is when the market opens, right? It's going to open at 6 o'clock New York time, 5 o'clock Chicago time. That's the start of a new auction, and you're going to end up buying or selling imbalance, then stopping, developing, and if you can kind of visualize that and understand that, and kind of make that the foundation of your learning, like you talked about the organic profile, the organic mechanism of creating a database, and then integrate what is the market structure and volume into that as well. Then I think I think everything's got to be put in context. That's why it's hard to trade. I think like looking at the way some people just might trade 1 minute bars or something like that. I mean, you got to kind of put that in a container of relevance and look at the NASDAQ. You can't, it's impossible.
How many dead gunslingers do we know?
Right. Oh yeah. Right.
Like having some sort of structural process, or in this
Yeah.
case, an organic way. And I remember one of the questions back in 1991, people are like, well, why do we need this software? And Pete's answer was that the markets are going to be 24/7 and that you're going to have to go to sleep. And then when you're in the ring, of course, you saw everything and you knew every player and you knew their position if you had half a brain, right? And so Pete's point was that you needed to be able to be in step with the market when you woke back up and
Right.
stepping back onto the roller coaster that had been fully roller coastering while you were sleeping.
Yeah. And that kind of goes in line with way back when, like in the late 80s, early 90s, you had a market imposed time frame of a day, so you could end it and restart again, and then nothing lost. But as you said, what 24-hour markets, you got US and Asia, then Europe, and then back to the US, and all those pieces of the puzzle. There's a guy that I know when he talks about it as a puzzle of the market. So I think that's a good way to describe it. It's a big puzzle, and you got to fit all the pieces together.
Yeah. Have you noticed a lot of traders do crossword puzzles?
Oh, yeah. No.
On the ring, right? They would be
All
they
right.
just tear through the Sunday
All
Times.
right.
And I'd be like,
Okay.
holy mackerel. They're, and yet, yeah. So trading is definitely like solving a puzzle every day.
Yeah. Mm-hmm.
And then this kid, Mike Wagner, who was on the floor, was like, he described it this way once, Steve. He said, it's like you're an artist and every day you walk in, you don't know what you're going to get. One day they hand you a hammer and a chisel. The next day they hand you charcoal. The next
Okay.
day they hand you paint,
Yeah.
right?
Okay.
Collage. It's
Right.
like you have to
Right.
make art with whatever they hand you that day. And
Sure. Mm-hmm.
so
Mm-hmm.
it's a strange thing of having to be in step with something that you have no control over yet. And you still have to make art out of that.
Right.
Hey, here, check this one. It says, find direction first. Then
Mhm.
ask if direction is something by price, is controlled by price, i.e. price control. Either you have direction that has price control or not price control,
Right.
right? And then, oh, and then he says back then it's even the things we were talking about, that reversion to the mean works 85% of the time. He said that, it should only be 15%. He uses that 85 thing that you're talking
Right.
about.
Yeah. I'm that kind of like you were on the floor. The trend days would be the days you'd kind of get your head handed to you, right?
Yeah,
You're trying, you have to trade, fade the order flow as a local, and then the markets are moving directionally. So every trade you're going to put on is going to
you can't get
probably
them back.
outsides. Yeah, you gotta
Can't get
keep
them
your
back.
losses cut. Yeah,
Yeah,
you
you
got fixed
can't get them
losses
back,
there.
right?
Hmm.
So everybody watching out there, remember that if you're a fader, remember that you're going to use reversion to the mean. Most of the time it will work,
Hmm.
but on those days where the market's leaving from a balanced position, don't be in such a rush to use that reversion to the mean program.
Yeah, and more importantly, I think just get out of the bad ones, right? I mean, that's what we've all seen, right? Is a lot of people will make it on the grind and then they lose it all in a day, and that's kind of the whole
Yeah,
in analogy what you're saying. 85% of the time it's just chopping around, and
yeah.
50% of the time it's trending, and they trending days they don't get out of the losers, and they lose everything they made over the previous 15 days versus a couple of trending days.
He says right under that, he says, look for increasing imbalances.
Yeah, yeah, that's kind of momentum, getting
Right.
momentum, right?
Yeah, in a sense, right?
Yeah,
Now remember, Pete used to always say price is the best marketing tool for more money to be allocated to something.
yeah, yeah, and I think it's always that's why I always try to look at the foreground versus the background. So obviously, if your foreground is telling you the market's negative, like the stock index is a great example, right? I mean, obviously the background will say the market is negative, and the foreground today the market is positive, right? So
Right.
uh, which which one is going to win out now, right? So that's going to be important. Is the foreground going to overtake the background, and now the market's going to have a sustained rally, or is the background going to overcome what we saw today and then have the market push back lower?
Isn't that an interesting question, right? You're looking for trapped, if in a sense, for everybody, we're all as successful traders, the most certain thing we can trade against is trapped people the other way.
Yeah,
And so today's foreground essentially trapped a lot of people looking for lower prices.
yeah, yeah. And I think it's now social media and Twitter and everything else. I mean, it's we've all heard of the people who look at the Wall Street Journal or Chicago Tribune, and there's a picture of a wilted stalk of corn on the front page of the Tribune, and then the market's in the big bull run, and obviously that's going to be the top. And then similarly, everyone's negative on the stock market and Twitter, and so but everyone's overly bared up and everyone's positioned that way. So you're in a good position for some type of a price reversal. But the question is it going to continue now, or is it not? And like we've talked about before, that's one of the Stoudemire things I always looks for, right? The long holiday weekends, and even though this is a couple of days delayed, I mean, could we be seeing a change? And like I talked about last week, in the dollar and the metals and the equities and fixed income. I mean, all those things have kind of today, even though it's a couple of days past the long weekend, we could be entering a phase like that. But
Yeah, well, I'm with you. Full disclosure to everybody watching, Steve and I have a taste for the short side, and we've used discretion in regards to it's like a bad habit, and for decades it was a bad habit. But anyhow, I bought a bunch of December calls yesterday because I didn't know when it would bounce, but I thought that the downside was just over advertised.
Yeah. Mm-hmm.
And so don't follow me, people. I am the worst buyer. I am a much better seller. Hey, it says here trading is direction like real estate is location.
That's an interesting.
Yeah, isn't that interesting?
Uh,
Recognize the degree of price control. In other words, strong means range trading, buy low, sell high. Weak price control means that you want to buy the breakout or sell the breakdown.
right.
Direction is the most important and removes randomness.
Yeah.
Find direction first, then ask if direction is controlled by price.
Yeah, I mean, that's like a lot of people, when the market's not moving, you've seen it, they're going to trade a bigger and bigger position, right? And then, they're looking to make a cent on a grain, or, a point on an S&P, and next thing you know, the market goes against their position. They've got a bigger position they would normally have, and there goes a chunk of their winnings for the year. But if you can kind of wait for the market to come out of the balance area and get some type of confirmation that it's moving out of the balance area, then that should be the launch point, right? I mean, if you understand the 4 steps of market activity, right, from the balance to the imbalance, and you should have some type of directional integrity and some type of a retracement of that directional integrity, and then at least you eliminated the one side and hoping you get favorable trade location, and at least you're going to be back pushing up towards the top of what the direction was before you started to have some type of a correction.
You people listening, tattoo that into the front of your cortex. Did Pete ever average?
Oh no, he was totally against that.
Just checking. He never spoke about it, so I figured he was anti-averager.
Yeah. I mean, truth be said, I mean, remember him telling me one story about a cattle position. He was very, very bullish on cattle, and I think his wife was pregnant with their twin daughters, and I think maybe he had to leave the floor and had to go to the delivery or whatever it was, and he had a position going, and then long, and then the market limit down possibly, and so he added, and then maybe even another limit down, but so we added, but then the market started working for him, and he probably made 7 figures on it. But that's the one time I can remember him ever talking about averaging. Now his philosophy is more, try to get in with a little minimum trend, a little imbalance, start of something that has potential for a bigger move. If it doesn't materialize, and just get out and start over again.
And keep looking for the, it's like the beginning when my best analogy would be I ski a lot, and I see when snow breaks in an avalanche, it starts out very slow.
Right.
But doesn't mean that it's not going to be bigger on the way down.
And then accelerate, right? Yeah.
Yeah, and here, I think this is a little bit later. He says, that things now happen quicker with bigger volatility. That people, as traders, we have lost the time element to get in and out, right?
Yeah, I mean, just look at, since you've been trading and I've been trading, I mean, ranges have become bigger and bigger and bigger and bigger, and that's I remember Pete saying it in 2000, and it's been true every year since then. There's never been a better opportunity than trade. I mean, if you're looking, people should be gravitating towards volatility, right? So when the markets have never been more volatile, and there's look at the crypto space and equities and fixed income, and I mean, you've never seen the ranges that you're seeing recently, right? So if you can manage the risk, your opportunity to make good money.
Here he says the key to success is, and you've heard this a million times in class, right? Stay with it as long as possible, but not too long.
Yeah, right.
And then vary your volume according to the opportunity. Who was that? The guy from Citadel said that, right?
Oh yeah. I mean, I think, and Pete always, one of his phrases you've heard many times, I'm sure, is that you buy your groceries with the short-term trading and put the money in the bank with the long-term trading. That's always been his philosophy. It's nice to be active and making money just to pay your bills, but then to really put the money away and then save for your future and buy things, you really got to kind of extend your time frame. And I think for him, I mean, he told me just last week that his biggest winner versus biggest loser, and that's always an important metric, is his biggest winner is 40x what his biggest loser was. So
and what was
trading 1 for 1 or whatever, it's hard to break even or make money with 1 for 1 or 2 for 1 when you're paying fees and all that kind of stuff. You got to be right more than you're wrong or batting 500. And if you're able to really skew your winners to a larger number, then you can just bat 200, 300 and still make good money.
He says suffer the exposure as long as possible. It has the advantage of fewer decisions and adjust supply rather than price. Therefore, you have to find a non-random environment, which offers continuation.
Right.
And then play the continuation and allocate money accordingly to that.
Yeah, you remember that 04 program we had. Remember that thing was
Yeah.
allocation, building a position, adding to your position, you know, you obviously you're not going to be perfect with your entries or whatever, but you have to suffer some adverse price exposure. But the adverse price exposure is be a combination of price and time, right? So if the
Yeah.
market moves against you for a little bit and then it comes back, you want to stay with it. But a lot of people just use a hard stop, and obviously we're advocates of using a stop. But I think you need to use a structural stop as opposed to a financial stop, right? So you don't want to
Yeah.
say every trade I'm going to put on, I'm going to risk $100 or 200. You got to say, this is an imbalance here. I put a trade on. If it retraces this imbalance level, I have to get out. That's $200 or $500. Do I'm willing to risk $500? If not, then I don't put the trade on. If I am, then maybe I trade a 1 lot instead of a 5 lot, whatever. But it's important to really manage your risk based upon structure and not a financial number.
He says here, big structural change will not be stopped by price.
Right.
It's going to unfold vertically rather than horizontally.
Mm-hmm.
And it has to trap somebody. Fast change, right?
Right. I don't know if you looked at carbon's kind of in vogue, and then you got the Paris Accord, and you had Biden do his thing, and I don't know if you saw that thing I put out a couple of weeks ago about carbon. It ran up to 99 cents and something like that, and now it's down to below 70, so it's lost 30%, of its value. And a lot of these proponents of green energy and everything like that, they think it's a higher price is sustainable, which I'm sure it is, but the question is, where's the higher price? Is it going to settle at 50 cents or 70 cents or who knows where?
As we know, price only exists to facilitate the transaction, right? So that makes cheap or rich subjective.
Right. Yeah. Right. It's a function of your understanding of everything and your external, influences and noise and everything else. Right. That's why, I don't know. I'm not a big follower of news and things like that. Maybe it's reading the data and, obviously things happen. And my friend sent me something this morning about Powell and his 75 basis point. I wouldn't have known that something was happening, but now you have put that in context, and that's external information you can factor into your idea. But that doesn't negate the fact that the market broke and rallied, and is that something important? I would think so, right?
Pete always talked about time, right? The speed of price through time.
Right. Mm-hmm.
Right. Are there what's your most recent thinking about time? We obviously have lost the privilege of time because now it's a very urgent marketplace, right?
Right.
It seems as though there's nothing top of book on the ladders, right? And there's every day the Fed's repo is 2 trillion. So there's 2 trillion just looking for a home.
Right.
And so first, everybody needs to understand that time is a relative metric in regards to how price is moving through time.
Mm-hmm.
Is that right? That's right.
Right. Yeah. Mm-hmm. Mm-hmm.
And time is an expense to all of us individually, as though we only have so much.
Finite amount of time, right?
Right.
Or a human being or an option position or whatever, right?
Right. And when people are wrong, the markets are moving quickly, affording them no time.
Yeah.
Right. So, how does one, and then if you get in other words, the most advantageous time to trade is when the market's moving quickly, which is essentially giving you no time to put the trade on.
Right.
Right. And then Pete goes on to say, how do we manage time? And, is it just is price, the only way price is related to time is that we're using the speed of price, not necessarily price.
Yeah, just the speed of the price change, right?
Right.
That's important, and I think if you're looking at, where is the market and where was the market, I always like to kind of think of what is the minimum trend.
Mm-hmm.
So obviously whether you're looking at some big composite unit or kind of something in a minimalistic perspective, you're gonna see some reference, that's gonna kind of tell you that there may be some subtle change in the market. And if you're not able to pick up the subtle change, then like you said, do you want to buy time? Do you want to buy an option? Do you want to put on a position with the expectation of a market move with the idea that you're going to eliminate the side of the market? Or do you want to be more reactive and based on a minuscule move that maybe that's going to set the tone for the move? So, I mean, for me, I'm always trying to look at where the market's kind of moving a little bit, but obviously a lot of those situations, they peter out, right? But, I guess that's the ultimate decision that one has to make in their trading. I mean, you've heard about some of these statements like good fill, bad trade, and different things like that. I mean, do that difficult trades, so
Right.
I think that, if you're able to put something into structure and then kind of become, somewhat astute at it, then I think you can put yourself in a position where you're able to get something going with the right side of the market, have the bias set up correctly, and you're going to not buying time, obviously, but you're going to be set with a position where you can kind of add your position. That's, you talk about adding, he's not a proponent of adding to a loser, but he's a proponent of adding
To
when
winners.
it's working.
Yeah, and he would always caution us too on that how it, it obviously reduces your average, or it makes you more susceptible to a retracement. Here, continuing with time, he says, as usual, he says, hold on as long as possible. Every losing trade is a time debit.
Mm-hmm.
And he says there are many more one-dimensional markets rather than two-dimensional markets. There used to be two-dimensional markets, right? That was a horizontal distribution before we had just-in-time inventory in the mid-90s.
Right. Mm-hmm.
Right? And then, so he says, if you squeeze time out, you get bigger results.
Mm-hmm.
Think in terms of time. Time efficiency is, or he says, time is wasted in markets. In other words, push problems till collapse. So that would be along your point where people are caught.
Right. Mm-hmm. Mm-hmm.
And so if you see that people are caught, we want to make sure that we're still part of that opportunity where we're pushing it till that side of the trade collapses.
Right. Mm-hmm.
And then there's a star here. It says, get timing down. Earlier trades are better than later. It can't be defined as wrong yet. Don't trade late. We already had that, right?
Hard to define, right? But potential.
That's pretty complicated way of thinking about markets in terms of time.
Right. I mean, I think one thing that I've always felt is important is that to have a diversified portfolio. So, a lot of times you're going to look at a market and it's maybe more consolidating, and then you look at some other markets and maybe there's some moniker or something in there that you're familiar with, or something that you look for as far as the setup goes that are more indicative of something moving vertically. So I think it's helpful for a person to look at a bigger universe of markets and kind of build up an idea of what is a good setup or a strategy to trade, and look to overlay that strategy in all the markets. And maybe if they're looking at 10 things in a day, they might find one or two that are relatively clear cut. You and me looking at equities all day long. I mean, sometimes it's like kissing your sister, right? I mean, it's not too rewarding, but it doesn't mean you can't try to approach that market. But if you kind of spread out in other markets, there might be something that's going to offer a better reward for you.
I remember Pete used to say all the time in class, he'd be like, instead of learning to if you're a fastball hitter, instead of learning to hit a curveball, just crush fastballs.
Yeah, right.
Remember those?
Yeah. He always said, why would Shaq practice free throws, right? 50%.
Hey, we've bumped up against an hour.
Okay.
So, and it's long for people to watch. Do you have any? Do you want to tell people about your book?
Oh yeah, if you're interested in the market profile at all, I think in 2002, I wrote a book. Myself and Peter Stoudemire, I was actually the author, but we're both listed as authors on the book. Stoudemire on Markets, Trading with Market Profile, second edition. I think it's a good book that gives you lots of perspective on what is the legacy profile, which is what we used from when Pete first developed it, from 83, 84, 85 up till we started developing software, which was 91, and then we kind of went off into the organic time variable profile that Chris had made reference to. So I think if you're interested in learning more about this approach, Wiley's the publisher. That would be a good book to read if you're interested in hearing anything about a software product, we have, that Chris uses and I use, and we have a lot of users and using it. It's a good product, I believe. It's an uplifted profile. You can go to my website, profiletrading.com, and I'll be happy to show you what it's all about and answer any of your questions.
And for everybody watching, Steve is good friends with everybody at Lucci, and so am I, and we are very happy to be part of the Lucci community. And so that's also a very good, supportive, smart, aggressive, active traders, right? That Pete would be very proud of, and hopefully we'll get a chance to get Pete to come on. So again, thank you everybody for coming. Keep the cards and letters coming. And Stephen, good to see you. And again, thank you all for coming, and see you later.
Yeah, thank you very much.